In our previous two video blogs, we introduced the basic idea behind digital tax accounts and the vision that the Treasury had for them. In this video blog, we will consider how they indicate that the digital tax accounts will work in practice. Please join us on the other side of the following statement. We are told that HMRC are currently updating their systems so that all the information that it already holds will be shown in the digital tax accounts. Through the PAYE system, they already hold information about pay and tax deducted from employment and pension providers. This is supplied regularly to them under the real-time information system. Forms P11D provide them with details of other taxable benefits from employments. Other state departments eventually will feed in data about state pensions and other taxable benefits. Banks and building societies will provide details of interest paid on savings accounts. And they intend publishing discussion documents on how information about other forms of investment income can be collected. From 2019, capital gains tax on the sale of residential properties becomes payable 30 days after completion. No doubt this will also be fed into the system. But the most significant change for all business owners is the proposal that the self-employed and landlords will be required to keep track of their transactions digitally and update HMRC quarterly via their digital accounts. The regular supply of details of income, benefits and gains into the digital tax accounts will enable them to continuously calculate tax liabilities. For businesses, the tax accounts will amalgamate amounts due from all types of taxes. Thus, it will include PAYE, VAT, corporation tax. They say eventually it will also include business rates. Due to the submission of the quarterly information, the tax due amount can be calculated but will consist on the one hand of actual tax that is due and payable and potential tax. The amount calculated will include tax which may already be due for payment and tax which may, under current rules, not be payable until many months in the future. It's more than likely, however, that despite claims by the Treasury that digital tax accounts will simplify the tax system, there is the potential for this to be very complicated and extremely difficult to understand, and is likely to give the misleading impression that there's always some tax that is owed. And that, in a nutshell, is a likely motivating factor by the Treasury. They say they will make it easier to make payments. A new system of online billing will mean that anyone owing tax will be able to see a calculation and pay what they owe. Do you think they'll separate out the tax that's only potential and or not due for payment yet? And correctly advise taxpayers that it is not yet due? By using the information and displaying it digitally, they say they will make life easier for taxpayers and make the collection of tax more efficient. I'm sure everyone will recognise that at least one of those statements is correct. They fully acknowledge that the increased information will enable them to identify those who bend or break the rules so that they can be tackled earlier, thereby avoiding expensive tax inquiries. In our next blog, we will consider the significant impact on businesses of quarterly digital reporting and just how they say everyone has got to do it. Please subscribe to our video channel on YouTube to keep up to date with each video blog as we issue them.